Have you ever just stopped and wondered how we can possibly put a single number on the entire economy of a country? I mean, it sounds impossible, right? But it turns out there's a really cool logic to it. Think of a country's entire economy like a giant coin. Today, we're going to look at both sides of that coin to really understand how economists measure all that activity.
So, here's what we're going to cover. First, we'll tackle the big question. How do you even start to measure a nation's economy? Then, we'll look at the two main ways to do it. One side of the coin is adding up all the spending, and the other is adding up all the income. We'll even run through some examples, talk about the common mistakes, what not to count, and finally, we'll get into why this one big number matters so much.
So, how on earth do you measure the total economic pie? You've got millions of people buying, selling, creating, and working every single day. Well, it all boils down to one simple but really powerful idea. Seriously, think about it. When you buy a cup of coffee, that money doesn't just vanish. Your spending becomes income for the coffee shop. The owner then uses that income to pay their barista, to pay the coffee bean supplier, and hopefully to pay themselves. And that right there, that's the magic insight. Every single dollar spent is also a dollar earned. Your expenditure is always someone else's income.
And that leads us right to our main concept, national income. The official definition is it's the total value of all the stuff, all the goods and services a country produces in a year. But as we just figured out, we can get to that number in two ways, either by adding up what everyone spent on all that stuff, or by adding up what everyone earned from making it.
All right, let's start with side one of our coin, the expenditure method. This approach is exactly what it sounds like. We measure the entire economy by adding up every last cent spent on final goods and services. It's basically like trying to collect and tally every single sales receipt in the country for a whole year.
And this is where we get one of the most famous formulas in all of economics. Gross domestic product, or GDP, equals C plus I plus G plus NX. Okay, that's a bunch of letters, I know. But what do they actually stand for? Let's break it down right now.
So C is for consumption. That's all of us, you and me, spending money on groceries, movie tickets, new phones, you name it. I is for investment. Now, this isn't about stocks and bonds. This is about businesses spending on things like new factories, machinery, and equipment. G is for the government. Think of all the money it spends on roads, schools, defense. That's G. And finally, we have NX, which is net exports. To get this, you take the value of everything a country sells to the rest of the world, its exports, and you subtract the value of everything it buys from the world, its imports. Add those four things up and you've got your GDP. Okay, time to flip the coin. If the expenditure method was all about tracking where the money went, the income method is all about tracking where that money came from. It asks the question, who actually earned all the income that was created by producing all those goods and services?
The big idea here is something called factor income. See, in economics, all production needs four key ingredients, or factors. There's land, which earns rent. There's labor, which earns wages. There's capital, like machinery, which earns interest. And there's entrepreneurship, the big ideas, which earns profit. Every single dollar of income in an economy can be traced back to one of these four things.
Now, to make the math a little easier, economists usually group these incomes into three main streams. The first and biggest is compensation of employees. That's all the wages, salaries, and benefits people get from their jobs. The second is operating surplus, which is kind of a catch-all for income from property and businesses. And the third is mixed income, which is for all the self-employed folks out there, like small business owners, where it's tough to separate their salary from their company's profit. So that operating surplus category sounds a little vague, right? Well, it's really just a bundle of the other factor incomes we talked about. It includes the rent earned from property, the interest earned from lending capital, and the profit that's left over for entrepreneurs. So when you add up all these income streams, the wages, the rent, the interest, the profit, the total should, in a perfect world, equal the exact same number you got from adding up all the spending.
All right, that is enough theory. Let's get our hands dirty and see how these two methods actually work with some numbers. This is where it all clicks into place.
Okay, let's run the numbers with our expenditure formula. So in this imaginary economy, we've got private consumption, that's C, at 800, government spending, our G, is 450, investment, or I, is 125, and net exports, NX, is 30. We just add them all up, C plus G plus I plus NX, and boom. We get a total GDP of 1,405 crores. Simple as that.
Now let's try a calculation with the income method. And yeah, this table might look a little more complex at first glance, but trust me, the principle is exactly the same. We're just adding up all the different kinds of income. We've got wages and salaries, we've got employer contributions, rent, interest, profit, all that stuff. You add it all up, and in this case, it comes to 280 lakh. The important thing here isn't the specific numbers, it's the process. We're summing up all the earnings to get to that same big picture number we got from tracking all the spending. Two different roads, same destination.
Okay, so knowing what to add up is one thing, but you know what's just as important? Knowing what to leave out. To get an accurate number, you have to be super careful not to count the wrong things, or even worse, count the same thing twice.
The golden rule is this: you only count the value of newly produced goods and services within that year. That's why we don't count the sale of a used car. Why? Because its value was already counted way back when it was first sold brand new. We don't want to double count it. Same reason we exclude what are called transfer payments, like pensions. No new good or service has been created, it's just money being moved from the government to a person. And things like winning the lottery or buying stocks, also out. They're financial transactions, not new production. So we go through all of this trouble, all of this complicated math, just to get to one giant number, GDP. But why? What does it actually tell us about a country? Well, for starters, it gives policymakers a crucial snapshot of the economy's overall health. Is it growing? Is it shrinking? But it's more than just the total size. How we calculate it gives us deeper insights. This quote really hits the nail on the head. The income method in particular is so powerful because it doesn't just give us a total, it shows us how that national income pie is sliced up. How much is going to wages? How much is going to profits? It helps us understand the distribution of wealth in a society.
And that brings us to our final and maybe most important question. GDP is an amazing tool for measuring economic output. There's no doubt about it. But it doesn't measure everything. It doesn't tell us about happiness or inequality or the health of our planet. So if a country has a really high GDP, does that automatically mean its citizens have a great quality of life? That's something really worth thinking about.